Good morning. Today is Wednesday, October 12th. Welcome to Forex In Four. Alrighty, this morning we're going to start out with the euro, and you can see here Euro's bounced higher, and it's moving up here. We're just got up to about 138. We're pulling back a little bit, just ahead of this R2 pivot resistance, which may act as support. If not, I think 137 is going to be a pretty good place right here. But yesterday we identified what we call a bull flag in the euro, which is a let me see if I pull it back here, if I can still get it. On the 2-hour chart, we identified this bull flag that essentially it shows that we're expecting that the price of the euro is going to potentially go up to 139, and you can see 138 got hit pretty easily today, and it looks like the trend is continuing higher. Well, what's going on in the eurozone? Well, first of all, yesterday Slovakia actually delayed their vote to ratify the EFSF expansion that they had agreed upon in principle on July 21st. Well, you know, it's interesting. They're the last country that needs to ratify it, and you know how they perhaps they're trying to jockey for some sort of accommodation or something like that. They're sort of in the catbird seat, as I mentioned yesterday, but it looks likely that they're going to go ahead and ratify that. And then we also have a plan that's going to be put out today by the Spanish Prime Minister. I think he's presenting, or Finance Minister, that's going to be a recapitalization of the bank plan. So those are all good first steps. All right, and then we also have the German, the Franco-Prussian pledge, if you will, to come up with the solution by the early November. So these things are all seen as positive in the markets, all right, and they're responding accordingly. All right, we've got some risk taking going on this morning. All right, and you can see here that got Australian dollar pushing higher, all right, as well. We're back up over parity. Okay, you can see that move here. This is the 2-hour chart, but we can back it out to the 30-minute chart and get a little bit more granular. So you can see here, bounce up 99 cents, boom, we're up above parity. I think we're going to stay there for a bit. Just to give you an idea of what's going on in Australia, they had, let's see, what did they have? They had something that popped up. Where is it? There we go. Home loans. Home loans figures were up, and they were a little bit better than expected, which is a good thing. It just means that there's positive activity going on, all right, and it doesn't mean that they're getting crushed by anything. We can look at the Kiwi, all right, the New Zealand dollar, which trades similarly to the Aussie, obviously, because they are closely related. But you'll see here, all right, that looks like the same exact chart. You wouldn't be able to tell the difference, right? So when you think about it, what's happened in New Zealand? Well, New Zealand, they actually had home prices come in, and they came in a little bit better than expected. So that's a decent thing. That they're hoping that price levels will stay steady, that they're not going to see deflation, that they can sit tight with interest rates, that the RBNZ can sit on the sidelines and sort of wait out and see what happens with the economic malaise. I mean, essentially, it's potential U.S. recession and the euro debt crisis, which is sort of holding up the entire world, if you will. So that's what we're looking at with Aussie and Kiwi. I also wanted to mention that as long as we're in that part of the world, let's take a look here at Japanese yen. You can see we had this big move here. And this big sort of spike down, and then we came back up. But if you think about it, it's not that huge of a move when we back it out. Just we've been in this very tight range here for a little bit, and one of the things going on is that in the U.S. they passed the Chinese bill. Okay, that in the Senate that says they want to force China to do something about their currency. So that's going to have an impact on some of these Asian currencies. And also, Japanese machine orders came in. They were much higher than expected, posting 11% versus a 3.9% gain. All right, and then a 2.1% gain for the year over year versus a negative 3.6. So you can see that they're really coming back online after getting back to after the tsunami and all of these other things that took place. So that's kind of what's been going on in Japan. Also, there's been some talk that Japanese yen they want to weaken, and we may see some action. Most likely something muted, but the Bank of Japan is starting to harp about the stronger yen, which is a problem. Just want to switch over to the pound here. Take a quick peek. Now the pound's also higher, right? Because we have dollar weakness, we have risk taking going on. We can see S&P. I'll start right there. S&P 500 back up over 1,200. All right, that's a good sign. We've got gold, which is sort of a little bit higher. It's puttering around, getting back up to that 1,700 level. I mean, it's obviously well off of the highs of 1920. But gold's going to be an interesting story going forward, and how the market responds to it, whether inflation causes gold to rise, or the threat of deflation causes gold to rise, or if it's just general safe haven properties, okay, or if it's actually going to decline if we get some clarity in markets. So we're going to keep an eye on gold. But getting back to the pound. Okay, yesterday they came out with their GDP estimates, all right, for the month of September, and it was actually higher, up 0.5% versus 0.2%. And then this morning they had their unemployment figures that came in, and the jobless claims came in lower than expected, meaning less people reported being jobless. All right, they were expecting about 24,000 people to say that they now didn't have a job, but the number that they got was actually 17,500, so that was less, which is a good thing. Okay, but the only problem is the unemployment rate ticked higher by 0.1%, up to 8.1%, versus the unemployment rate of 8%. Now that could be, for any number of reasons, but you can see here that they were expecting the unemployment rate to rise just a little bit. It rose more than expected, but the jobless claims change wasn't as high as expected. So coupled that with the risk taking in the market, and you can see why the pound is higher. But it's back up over 157. That was our target from I believe last Tuesday, so that was still intact, which worked out nicely for those who took advantage. And we'll just kind of focus back here to the U.S. Let's look at U.S. CAD. Oops, that's not U.S. CAD. Let's look at, like I said, U.S. CAD. All right, now we're moving back down towards parity here for dollar versus the Canadian dollar, or the loonie as it's known. Housing starts figures came in yesterday for Canada, much better than expected, roughly 206,000 versus an 190,000 expectation. So that came in better than expected. And then we're going to see housing prices from Canada as well. Now, what we're also going to get today, the big news going out for the rest of the day, is the release of the Fed FOMC meetings from the September 20th meeting. Now this is going to be important because this is going to show us how close the Fed is to QE3 and what they were thinking. I mean, we heard about it in Bernanke's speech to Congress at the Joint Economic Committee, but now we're going to get an idea of what they were talking about at the Fed meeting, and whether or not they're actually considering doing more stimulus, whether it's in the form of QE3, more bond buying, or we know about Operation Twist, but perhaps there's something else out there that could take effect. So a lot of interesting things going on, but not necessarily these significant data points. So we could see a little bit of additional volatility this afternoon, especially if people think, hey, wait a second, Bernanke just threw out that bone at the Joint Economic Committee, because markets were tanking, and maybe they have no intention of doing QE3 at all, and the minutes are going to reflect that, which could be bad for risk. So we're going to have to just keep an eye and ear out for that and see how it goes. But right now, markets are seemingly higher. You can see that we've got the start of the trend going on here with Euro, and that 139 target looks pretty attainable. So I think maybe, perhaps if Bernanke and company did hint around about that, then we could get that push higher going into the rest of the week. So, Euro, there was some other stuff that came out here. Wholesale prices, consumer prices, CPI came in a little bit lower than expected, which is all fine and dandy. But, the big story, obviously, is Euro debt crisis over there. And then, let's see, later tonight, or I guess tomorrow we'll call it, we're going to see Bank of Japan's going to publish the minutes of their meeting. All right, and then we're going to get the Australian employment change figures as well for tomorrow. So we'll see better readings on CPI in Europe. But again, I don't think that's going to affect the Euro as much as the debt crisis numbers will. But you never know. I mean, markets are looking for stuff to trade on, and it's sort of like we're in this holding pattern as we wait for the Euro debt thing to play out. And, we know, okay, they're going to supposedly announce on the early November what the plan is. All right, but markets aren't just going to sit on their hands until then, because you know how that goes. So we're starting to see stock earnings come in. Mixed bag, some a little bit better than expected, some worse than expected. But again, the expectations have already been lowered for most of these companies. So I think people are ready to put some risk on. If we can just get the government out of the way, and I think the first step in that direction was the Senate rejecting President Obama's, quote, jobs bill. He didn't even get full Democratic support for it, let alone no Republicans voting for it. And at the end of the day, it's just more doubling down on failed policy. More government spending, raise taxes, we get it. Shrink the pie, don't grow the pie, and somehow that's going to put people to work. Everyone says, well, God, don't you want to have more people working in all these public works projects? Yeah, of course you do. But you know what? You can't do it if you don't have the money to spend. And by trying to take money from one group and hand it to another group, All right, that money's going to come from somewhere, and we're seeing it with this regulation. There's this backlash against Bank of America for charging a $5 debit fee. Now, well, how can they do that? Well, guess what? Their costs have gone up thanks to the government, so they're passing it along to the consumer. If you don't like it, don't go to Bank of America. All right, but to sit here and vilify a company, all right, for trying to maintain profitability doesn't make any sense, and that's part of the philosophical difference we have here in the U.S. right now, is that somehow people think the government should be controlling all these things and not the free markets, and that's a real issue, because what, I think infrastructure projects would be a great thing to do, all right, but you got to do it in a way where you find the money by cutting spending somewhere else. It's like you're a homeowner and you look at your family balance sheet. I mean, you can think about it in terms of your own household, all right. You probably have a lot of projects around the house you want to do, all right, but if you don't have the money, you can't do them. All right, so what do you do if you do want to do them? Okay, well, maybe you got to find spending by cutting something else. So maybe that's no vacation this year. Maybe that means less eating out. Whatever the case is, you don't just say, "Oh, I want more money." You go barging into your boss's office and demand a raise. Guess what? He's probably going to laugh you out of the office, and you'll be lucky if you still have your job. All right, so the government doesn't get it. All right, they don't understand that. Wait a second. You can't just start taking money from one group and giving it to another, and saying, "Why don't you want this to happen?" I mean, they throw a couple bones into the bill. Well, why aren't you for tax reform or tax relief or payroll tax holidays? But it's kind of like, you say to somebody, "You know what? I like pickles." And someone gave me a pickle sandwich on top of a steaming pile of dung. All right, guess what? I'm not going to like those pickles too much. And you say, "Well, why don't you want to eat the sandwich? It's got pickles on it. You love pickles." Yeah, but the pickles are on top of a steaming pile of dung. All right, so I'm not going to eat that sandwich. And that's what we're seeing in government right now. So, I think as we get closer to the elections, we start nearing, what's perhaps the end of this sort of, I don't even know what you want to call this philosophy. Let's just call it socialism, for lack of a better word. We're going to start to see things pick up. So, business can only sit on the sidelines for so long, despite the uncertainty in the markets, and I think we'll start to see a little bit of pick up here in the fourth quarter. So hopefully that does something for unemployment. Hopefully that goes down a little bit. We get more people back to work, and this country starts to function again. So anyway, that's what I've got for today. Keep an eye out for those Fed minutes later today, and good trading to all.